Hey everyone, John Henry here, slingshotfeatures.com. Today we're going to be taking a look at market structure in the overall kind of backbone of the markets. Now, we've done a video before on market structure, but what we want to take a look at is identifying the best zones of interest. Now, when it comes to identifying market structure, there are a few viewpoints that we need to take. First of all, obviously, we need to start from the top down. One of the biggest things that a lot of traders don't do is they don't zoom out far enough. They'll keep looking at the exact same chart. And there's nothing wrong with faster time frames with market structure, but generally speaking, the ones that respond better are the ones that happen on a bigger time scale. So keeping that in mind, what we're going to do is we're going to load up a brand new chart. And let's look at a market that we don't really look at very often. Let's take a look at, let's take a look at copper, sure. I'm not exactly sure what month copper is trading, but we'll take a look at copper. And we're going to load up a 60-minute chart, okay? Now, when it comes to the time frame, it's a personal choice. I like 60-minute charts, but there's nothing wrong with, a 4-hour chart or even a daily chart if you really want to zoom out. All right, so let's get this chart loaded over here. So we've got the copper market. Now, copper trades the most volume on the 519 contract at the moment. So now, obviously, the chart looks a little bit messed up. So let's just go through and clear everything off. Let's get all the stuff off. We don't care about anything but pure market movement. Now, first of all, what is market structure? Market structure is the backbone of the market. It's the overall moves. If you were to draw a line from point A to point B, that would be the market structure. Now, this is where things get very interesting because you could subdivide all of these moves in very, very tiny increments. You could say, well, this could be a move, and that could be a move, and that could be so you can really break it down. But really what I like looking for is multiple levels of confluence all coming together over and over and over and over. It seems to be a level that the market just appreciates, respects, whatever you want to call it. So one thing that we can see here on copper is that it seems like something's going on inside of here, right? It's not very difficult to see. We had resistance, 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 resistance. We also had support 2 times there, close touch support, even a pause there, resistance, resistance. You get the idea. There's obviously something going on here, and this would be a zone of market structure. So what we want to do is label that zone, right? We want to keep an eye on this area. Now, the beautiful thing about zooming out and looking at the bigger picture is it doesn't have to be exact. It's not like, okay, well, it has to be exactly 2.7813. No, we're looking at a 60-minute chart zoomed way far out. Remember, you have to keep in mind that this is more of a zone of interest. Now, the one thing that you could potentially do is just thicken up the line a little bit and say, okay, well, this zone, make it a thickness of 10, that's the band of interest. And you can see it fits pretty darn well. That would be a level that I want to keep an eye on. So now that we have a level of structural interest, and we're not digging into all of them, there are plenty more. If we take this line, we can drag this a little bit further down. We can see that yet again, there's another area of interest. Anytime you see these several times where it comes down and tests it, and this is actually a really good example. This one I might want to bump a little bit higher so we include that low. So we'll get that inside of there like that. But that's all you're really doing. It's very simple, very straightforward, but you're just zooming out and looking at multiple levels of confluence that are bouncing the market around and showing areas of support and resistance. And really quick, here's another one that just stands out like a sore thumb. So now what we can do, now that we have that zone of interest, we can zoom in a little bit closer and look at what the market is doing. Now, this is where a lot of traders are mainly focused on market structure. And this is why a lot of times when you're trading market structure, it doesn't really work that well because you're not zooming out. Now, when we're zooming out, we're finding these areas of interest, but now we want to see the market responding to these zones. If you're really aggressive, some traders will just drop a sell order smack bang right on top of that level and say, you know what, I've got my stop, I've got my target, good enough, and that may be all you need to do. As long as you're utilizing a good enough reward versus risk, I can't say that I disagree with that approach, but a lot of times you want to see a little bit of a response. I want to see the market respecting that area. You could be using order flow, you could be using indicators, you could be using just market price action, whatever your go-to method is, but that's what you're looking to do is watch and see if the market is respecting this area. Here we can see the market came up, tested that zone of interest, and couldn't even close above it with huge tails on the top. That alone will get a lot of traders interested. There will be sellers underneath these bull bars here, or they may wait for a bear bar. But either way, that is going to gain a lot of interest from the sellers. And again, there's a few ways you can approach this. A sell order here with a stop above the highs and a target maybe back down to, zooming in a little bit, market structure on the faster time frame. And it seems like there's a good amount of market structure inside of here with all of that support. You might even want to bump it up a little bit further and say right there. So if you're taking a short right here, your stop is here, and you're looking for a target down there, that's a pretty good reward versus risk. But the beautiful thing is, you're not only using one thing, you're combining it with multiple levels of interest. And we can do that by looking at a faster time frame's market structure. So let's zoom in really close and look at a 1 minute chart and see what happened here. Now, as we can see, as the market came in, we can start seeing it developing a level of confluence right inside of here. Now, this isn't necessarily, because it is so far away, an area to immediately short into, but we know that we're creating a band of interest inside of here. And if the buyers fail this move to the upside, then there's a good chance that the sellers may swarm in and take back over, given that we're cycling off of a massive level of resistance off of the hourly type of structure. So what are we looking for? Well, we know that we have a potential high being created somewhere inside of here, and we know that this zone inside of here is creating a secondary zone with the larger time frame right inside of here. So this whole area is a level of resistance. So we want to find where the buyers are giving up. Right? So if we know that roughly we have a level of resistance inside of here, when we see the buyers trying to break above that area, the last time it was a failure, they finally break above it, only to test that resistance and fail right back down again. But what happens? Right? They come back down to support and they bounce off of it. They try getting it to go higher and then it fails back lower. And that's the sign that the buyers have, in this case, almost very likely, completely fallen apart. They tried getting the breakout move above, they probed the highs, but nobody was there to support it. When it came back down, it bounced just a little bit and then faded back through. And this is where things are going to get very interesting, because now we've got a big area of interest to work with, right? You could look to sell the potential breakdown right away, a really aggressive early entry. You could also look for a Fibonacci pullback. That looks to be about a 50 or 61.8% sell right there. You could also look for a divergent high. You know, there is very likely a divergence inside of this that you could be looking for, or at least a negative divergence, looking for a sell. Maybe you want to break out pullback, right? A retest, something like that. There are just tons of different ways to get into it, but this is the approach when you're looking at market structure. Yes, you have the market structure area of interest, but do you jump straight in and just load up the boat with a bunch of contracts? Not necessarily. If you have a big enough account, you can probably get away with it, I'm sure. But generally speaking, I want to try to pinpoint my entries a little bit better than that, because by pinpointing my entries, now I can very easily define my risk. So if I'm looking at this and saying, okay, well, I know that I want to sell somewhere inside of here. We have a breakdown move right there. We finally close underneath it. I'm going to sell the close of that little bitty bear bar right there. Well, now that gives me something I can work with, because this is my short entry. My stop is very well defined right above the highs, right? That swing high, that's my stop loss. Nice and easy. And because we can so easily define our risk, we can also very easily define our reward. Now, zooming into a 1 minute chart, you can blatantly see that price structure coming inside of here. So that's going to be my reward target, right? Or maybe a little bit ahead of it just to play it safe. So if we bump it up just a couple ticks right there. So if I look at this and I say, okay, well, this is my risk, this is my reward, does it make sense for this to actually fit inside of that? Does it fit the risk parameters that I need? And is the probability supportive of this risk reward? As an example, talking about probabilities, we've done tons of videos on that. But if I'm looking at this and saying, okay, well, I think I have a 50-50 shot, and my reward is much larger than my risk, that's a perfectly good trade to take, because it lines up mathematically, structurally, and fundamentally with the markets and how they want to move, and ends up being an absolutely beautiful trade. We can do the exact same thing by going down to the next level of support, right? What do we have here? Well, the initial bounce, sure. For all of those traders who are very aggressive and just float an order waiting there, ready to bounce, they were rewarded with a very nice bounce higher. But if we look at this, when the market comes back down, notice how it doesn't respect it that much. And that's giving you some clues. The difference here, I mean, look at the response there. Beautiful rejection, a failure off of market structure. Here we have market structure, but it's forming underneath the larger one. It's not as good, right? And this is the importance of zooming into those faster time frames and really confirming, is this going to be a solid mover or not? And here you can see that was a horrendous move that really didn't get much going. and well, it was a pretty big clue given how weak of a support level that ended up being in hindsight, of course, now. But at the time, we had that initial bounce, and I think this is probably why it didn't end up working out very well later on, because all the buyers who were aggressive already made all their cash. They don't have to worry about it anymore. So when it came back, nobody else is left around to buy it anymore, and it causes a little bit of a chop and slop and just kind of a gross move compared to over here, which was a beautiful sweep all the way down to the target. So that's what we're looking for when we're looking for market structure, digging in a little bit further and saying, okay, well, I know where the level of interest is, but that's not good enough by itself. I need more information. I need context. I need a pattern. I need a signal. I need something to line up here to tell me, okay, I know I have a level and it seems to be being respected. This is a great place for a potential trade. And that's why it's so important to do a little bit more due diligence than just finding the level and saying, good enough. You want to zoom in a little bit more and try to take a look at what the market is actually telling you about that level of support or resistance. Very important. So that's going to do it for this one. As always, underneath the video, click on the thumbs up button, show us that you like the content. Of course, subscribe to the channel so you don't miss anything important. And to make sure that you don't miss anything important, click the notification bell icon to the right of the subscribe button so that you're notified every time these videos comes out so you don't miss anything important. So that's going to do it for this one. I hope you found it useful, interesting, entertaining, and maybe something you want to add to your tool belt if you're a big fan of support and resistance trading as a whole. It can be a huge implementation into trading and give you a great area of interest, especially when you're zooming in. Now you're increasing your probability or just putting some icing on the cake. That's going to do it for this one. I hope you had a phenomenal day of trading. Until the next one, we'll see you all then. Thanks.